All right, let's dive right in. Today, we are opening up the playbook on what is, frankly, one of the hottest and most overlooked sectors for business acquisition out there, HVAC. Now, if you think this is just about fixing air conditioners, you're about to see exactly why private equity is treating this space like an absolute gold rush. Let's get straight to the numbers.
First, let's just talk about the scale of this thing. We're talking about a $130 billion market. That's just in the United States. You know, this isn't some tiny niche. It's an absolutely essential service that touches pretty much every single home and building in the country. It's a foundational piece of the economy.
And it's not like it's a sleepy, stagnant market either. It's projected to grow at a compound rate of nearly 7% all the way through 2033. I mean, that is strong, steady, predictable demand year in and year out. But what's really lighting a fire under this industry is who's starting to notice.
That's right. Big money, the smartest money on Wall Street is absolutely flooding into this space. They're consolidating a super fragmented market at a record pace, which creates this fascinating dynamic. It's fierce competition on one hand, but it's also a massive opportunity for a savvy individual buyer. This is the core tension we're going to explore today.
So why all the hype? Why is everyone calling HVAC a recession-resistant cash machine? Well, it's actually pretty simple. When it's 100 degrees outside or it's freezing cold inside, your heating and air conditioning, well, that's not a luxury, is it? It's a necessity, and that non-discretionary spending is the absolute bedrock of this industry's appeal.
Now, if we break it down, this is where it gets really interesting. Yeah, residential makes up the lion's share, over 55%, which gives the whole industry this incredible stability. But look at those other slices, commercial and industrial. Together, they represent a huge and often way more profitable part of the market that the really sophisticated buyers are targeting.
And look, this isn't just about things breaking and needing a fix. There are 4 huge macro tailwinds pushing this market forward right now. You've got climate change, which means more extreme weather and higher demand. You've got government incentives fueling a massive shift to electric heat pumps. Our commercial buildings, they're old. They need retrofits. And the AI boom, well, all those data centers need precision cooling, creating a literal explosion in demand.
Okay, so the market is huge and it's growing. We've established that. But what does a deal actually look like? What are buyers really paying for these businesses? This is where we get into the real nitty-gritty of valuation.
Before we can even talk about multiples and price tags, we all have to be speaking the same language. For most businesses in this small to mid-size range, the key number is SDE. That stands for seller's discretionary earnings. Just think of it as the total cash benefit that one owner gets out of the business. It is the true cash flow, and it's what your purchase price is going to be based on.
And this table right here, this just perfectly illustrates how size and sophistication drive value. A small shop, say under $1 million in revenue, that might trade for around 3 times SDE. But as you grow, the multiples expand in a big way. And notice that shift from SDE to EBITDA for the bigger companies. For an individual buyer, that $1 to $5 million revenue band, that is often the absolute sweet spot. It's big enough to be a real business, but small enough to still be affordable and command a reasonable multiple.
But of course, not all businesses are created equal. So what separates a company that gets a 2.5x multiple from one that gets a premium 4.5x? It's really about moving from a job to a system. A business with a ton of recurring revenue from service contracts, a management team in place, a diverse customer base, and clean financials, it's just worth more. It's de-risked, and it's ready to scale. Simple as that.
Now, all of these factors, the steady demand, the growth, the chance to professionalize these businesses, it leads us right to our next big theme, the private equity gold rush. Understanding their strategy is absolutely key to navigating this market. Just look at this number, an 88% year-over-year surge in private equity add-on acquisitions. That's the velocity we're talking about. What this means is that PE firms are buying a main platform business and then just rapidly bolting on smaller local companies to it.
And these aren't small-time players, okay? We're talking about major platforms backed by household names like Morgan Stanley and Alpine Investors. These are the companies you'll actually be competing against for deals. And you've got to know they are well-capitalized and they are moving fast.
So why are they doing this? What's the secret? It's a simple and incredibly powerful financial play called multiple arbitrage. Here's how it works. They buy smaller companies at a low multiple, let's say 3 times SDE. They roll them all together, they professionalize the operations, and then they sell the much, much larger combined entity at a much higher multiple, maybe 7 times EBITDA. That gap between the buy multiple and the sell multiple, that is where fortunes are made.
Okay, enough theory. Let's see what this actually looks like in the real world. we've dug into a few businesses that are for sale right now just to show you what to look for. So let's start with this one. It's a combined HVAC and plumbing business in Las Vegas. Right away, that diversified service mix and that hot weather location, that should get your attention.
The numbers here, they tell a really compelling story. Over $4 million in revenue, that's solid. But the key metric, the thing you have to look at, is that $2 million backlog. That is exceptional. It gives a buyer incredible visibility into future revenue from day one, which dramatically de-risks the entire acquisition.
So, here's the bottom line on this one. A business of this size, this quality, with that kind of backlog, it's not just a lifestyle business. This is exactly the kind of company that a PE platform like Orion Group or Sila would be hunting for as a perfect tuck-in acquisition. It's a prime target, for sure.
Okay, this all brings us to the final and I think the most important section. Whether you're competing with Ps or just trying to find a great deal for yourself, this is your playbook. These are the 5 non-negotiable items to check off before you even think about making an offer.
Number 1, you have to look for recurring revenue from service contracts. It is the lifeblood of a stable business. 2, make sure you're buying a business, not a job. The owner cannot be the entire system. 3, technicians are gold. High retention is a massive asset. 4, make sure no single client can sink the ship. And 5, if the books are a mess, trust me, the business is probably a mess. No exceptions on that one. And if you only take one thing away from this today, let it be this. The single fastest way to create wealth after you buy one of these companies is to focus relentlessly on service agreements. Taking a company from, say, 10% recurring revenue up to 40%, it doesn't just add predictable cash flow, it fundamentally changes the risk profile of the business. And it can dramatically increase the multiple you'll get when it's your turn to sell.
You see, we're witnessing this huge demographic wave of owners from the 80s and 90s who are all looking to retire, and that's creating this historic window of opportunity. Given the nonstop demand and the proven paths to creating value, the opportunity is crystal clear. The only real question left is, which business is the right one for you?